Hello, this is Mijin from Mizoram University. Let's start today's Mijusi news for August 19th. Welcome to Mijun, where we continue to uphold the fundamentals of United States stock investing as always. This is the second Mijun broadcast I'm sending you from Kuala Lumpur after 2 weeks. Yesterday, after watching the Mijun broadcast for the first time in a long while, a lot of people left comments. As you all know, I'm a bit obsessed with your comments. Yesterday, a total of 246 people left valuable comments. Reading these comments made me feel really good, and it was a very meaningful day that gave me a lot to think about. Some of the comments said that I look healthier now. That's because I've gained a bit of weight. Since I came to Malaysia, most of the food is so delicious. The United Kingdom is famous for not having tasty food, but in my opinion, Malaysian food is among the best in the world. So, after eating so much delicious food, I've started to put on some weight. And another thing is, our kids finally went back to school yesterday. It was the school vacation period, and when the kids are on vacation, a problem comes up. They end up eating too often. When the kids keep saying they're hungry, I have a habit of eating with them whenever they eat. Because of that, I ended up eating all 3 meals a day without missing any. Now that the kids have started going to school, it's just my wife and me at home. So now we only eat twice a day. We don't eat lunch, so we have a simple breakfast and then an early dinner. We usually have dinner around 5 o'clock. I'm hoping that, like before, I might lose some weight this way. My body condition still isn't back to normal yet. It takes me much longer to get over jet lag than it used to. Those of you who have been with me on Mijun's broadcast for a while probably know this well, but I used to move a lot. So far, I've lived in 6 different countries for over a year each. And now, Kuala Lumpur is my 11th city. Over the years, I've lived in more than 10 cities for over a year in total, moving around and living in countless places, but I've never had such a hard time moving as I do now. I think age is also a factor. Now that I'm in my 50s, I wonder if it's time for me to settle down. Moving around is starting to feel a bit difficult, and I've started to think about these things. Anyway, I'll try to cheer up. I'll do my best today as well, so that this broadcast can be helpful for your investment activities. Alright, then let's get started with today's Big Two Shin news for August 19th. Today as well, let's start by going over the United States stock market conditions. The S&P 500 map is visible on the screen. Yesterday was nearly a mixed trend. About half of it is colored green and the other half is red. Well, there's no clear trend in the sectors either. The sectors that went up and the ones that went down are evenly mixed. One thing that stood out was that semiconductors, including NVIDIA, and software generally had a bit more green. Large cap stocks at the top, like Microsoft, Apple, and Palantir, are continuing to show a downward trend. Google and Meta in communication services also declined together. So it's a bit difficult to find a consistent pattern. Recently, the market has been such that stocks which performed well in 2025 have temporarily paused. So, as I mentioned yesterday, a rotation is happening. I think it would be good to understand it this way. If you look at the movements of the major indices in the United States stock market, this phenomenon stands out quite a lot. As I mentioned yesterday, what has been leading the United States stock market recently are micro-cap and small-cap stocks. Yesterday as well, micro-cap stocks rose by 0.47%, performing the best, and the second was mid-cap stocks. Mid-cap stocks rose 0.27% and small-cap stocks 0.15%, indicating that smaller market cap stocks like mid-cap, small-cap and micro-cap are showing strong price movement. On the other hand, the S&P 500, which is made up of 500 large-cap stocks, stayed flat at minus 0.02%. The Nasdaq 100 is made up of stocks with very large market capitalizations. That's because among the many stocks included in the Nasdaq index, excluding financial stocks, the Nasdaq 100 is a collection of the top 100 by market capitalization. The Nasdaq 100 fell by 0.04%. And the Dow Jones, which is made up of America's blue chip companies and representative companies from each industry, also fell by 0.12%. So rather than large cap stocks, recently small cap stocks have been performing better. We can confirm this once again. I've been saying for the past 3 weeks that the United States stock market has been led mainly by small cap stocks. The reason I analyzed it this way is not to suggest that we should switch to small cap stocks, and I want to clarify that once again. Why did I explain the United States stock market trend? I'm not saying you need to follow this trend or switch to selling something else because it's popular. We've already chosen the stocks to invest in. I have a topic called Retiring with United States Stocks. I choose 18 to 20 stocks and invest in them long term. But the reason I look at these trends is to check that even if the stock prices of the stocks I own aren't doing much right now, I don't need to worry about it. It's not that all the money is drying up and leaving the United States stock market right now, or that the market feels really risky or anything like that. The healthy bull market is continuing, but investment funds are just moving out of areas like artificial intelligence beneficiary stocks and Bitcoin-related stocks, which had been running hot until now. Funds are shifting into small cap and micro cap stocks, which haven't shown strong price trends so far. So, at times like this, instead of chasing after different stocks from the ones we already have, we just need to wait. Because as funds circulate like this, investment money will eventually return to stocks with strong fundamentals. I think it would be good to understand it this way. If you look at the rest of the market atmosphere, there was almost no change. Yesterday, the market breadth was 58 and 64, so you can see that there was almost no change. The percentage of stocks trading above the 200-day moving average is 60.43%, so there's really no change compared to the day before yesterday. The volatility index remains at 14.99 and the fear and greed index stays at 65, so there's little change. So right now, the overall market sentiment has been pretty much the same for a month. The general atmosphere of the market is being maintained, but the funds are just moving around here and there. Personally, I think the market is staying relatively healthy as funds are circulating from stocks that have gone up to those that have gone down and from sectors that have risen to those that have fallen. If you look at the performance of Mijiwon's top picks yesterday, quite a few stocks recorded gains. Pilsola surged for 2 straight days, climbing 9.69% yesterday. Secondly, Trade Desk went up by 5.43%. As I mentioned on yesterday's broadcast, in the case of Trade Desk, the relative strength index was formed at a very low level. Therefore, it was an oversold stock, and because it was oversold, there's a possibility that it surged more than 5% like this. However, I think it's a bit unreasonable to expect that this upward trend will continue in the long term. So, for those who have a high holding ratio of Trade Desk, or those who are planning to exit with this opportunity, taking advantage of a stock price rebound could be a good investment strategy. Cred Technology rose 1.71%, Tesla 1.39%, Taiwan Semiconductor Manufacturing Company 1.06%, Coinbase 1.00%, and Nvidia 0.86%. Lastly, yesterday, Vistra went up by 0.83%, finishing in the positive, while the rest declined, but overall, the drops were very minimal. Broadcom slipped 0.19%, Alphabet 0.20%, Talon Energy 0.25%, Celestica 0.31%, and Bitcoin dropped 0.31% to 115,900. In addition, Strategy dropped by 0.74%, Advanced Micro Devices by 0.77%, B2 by 1.15%, and Palantir also fell further by 1.77%. Lastly, Meta has not been performing well recently, and it continues to adjust, dropping by 2.27%. As I mentioned several times during last week's broadcast from the United Kingdom, now that I've moved to Malaysia, I've decided to slightly change the format of the United States-China broadcast. So instead of sharing lots of information like before, I won't do that anymore. I have a United States-China membership program that I run, and among the content I share there, I'm thinking of selecting the most important article and structuring the broadcast by reading through that one article together. And then, at the end, I'm planning to include the United States China podcast I sent you yesterday or a video about today's United States stock market and structure the broadcast like that. If any of you feel that you need more information about United States stocks or want to explore more content, if you have that kind of desire, you should consider joining the Median paid membership. So today I found a very important article, and I changed the title of the article like this: United States stocks offer the highest chance of investment success. So at the end of this article, I added a comment from Mihon. In Mijiwon's comment, I summarized once again why we leave Korean stocks behind and go all the way to the United States stock market to invest. I think it would be good if you watch the broadcast with a focus on this part. First, I'll read you an article. The original title of this article is "If the Fed Cuts Interest Rates, Can the United States Stock Market Keep Running?" And it's written about this topic. It's an important and intriguing question. We're expecting that the Fed is likely to finally cut interest rates in September. So the question is, if the Fed cuts rates, will the United States stock market definitely rally? That's the issue being raised here. Let's read together and see what kind of story unfolds. This year, the United States stock market has reached an all-time high as investors focus on Jerome Powell, the Fed chair's speech on Friday at the annual economic symposium held in Jackson Hole, Wyoming. Most stocks closed flat in the recent session. As we just saw, most indices and stock prices are remaining steady without much fluctuation. The reason is that there's a very important catalyst coming up on Friday, and investors are waiting to see how things move after that catalyst. There's an economic symposium held once a year in Jackson Hole, where the Fed chair gives a speech. And why is this speech important this time? As you all know, the big question is whether the Fed will cut interest rates in September or later this year, and if they do, whether it will be once, twice, or 3 times. We can get some very important information about that. So that's why investors are paying close attention to this. That's how you should see it. Stronger than expected second quarter corporate earnings helped push the stock market to near record highs, and expectations that the Fed will resume rate cuts in September have also added to the market's bullish trend. Now, if you look here, you'll see that the earnings were surprisingly strong and solid. It says this here. And if you look at how good the second quarter earnings actually were, there's another article here. Let me show you for a moment. It says that the second quarter of 2025 was one of the best earnings seasons ever, and that there hasn't been such good performance in the past 20 years. The only exception was when the United States economy suddenly crashed and then rebounded in 2020. Other than that, the best earnings season was the second quarter of 2025. That means expectations were a bit low, so that's how it can be evaluated. Since earnings exceeded expectations, the United States stock market sentiment has been positive lately. We should keep that in mind. So, one of the reasons the stock market has been hitting all-time highs recently is earnings. That's how you should see it. The second reason is the Federal Reserve, with expectations it will resume interest rate cuts in September. That's why the United States stock market is hitting all-time highs, according to current explanations. And then, the United States money market fund, known as money market fund, comes into play. The cash accumulated in MMFs has now reached an all-time high, and this record amount of cash is drawing the attention of many experts on Wall Street. The reason for that is this. If there is an abundance of cash-like assets like this, many people argue that this cash will eventually flow into the United States stock market, fueling stock prices to keep rising. The investment company Institute reported the figure reached $7.186 trillion last week. With over $7 trillion in cash-like assets outside the market, this money will eventually enter the stock market, causing the United States stock market to keep rising. That's the logic behind this. However, Tony, the head of hedge fund strategy at Goldman Sachs, has a slightly different opinion. He said this in a client report released on Monday. It's true that households currently hold about $20 trillion in liquid assets and cash. This accounts for only 15% of total household financial assets, which is said to be in line with the long-term average. Although the absolute amount has grown, it still makes up 15% of total household financial assets. This matches the historical average and remains steady according to them. So what that means is this. It suggests that there isn't an unusually large wall of funds waiting to be allocated to the stock market or elsewhere. Because dollar 7 trillion is currently in cash. You shouldn't argue that this cash will inevitably flow in someday. That's because, although the absolute value is at an all-time high, this dollar, 7 trillion, has always been about this much in cash as a percentage. That's the argument being made right now. Now, they're also showing a chart. It shows that in past cycles, when the Fed lowered policy rates, there wasn't a significant outflow of funds from MMFs. Money market fund assets. After the global financial crisis in 2007 and 2008, during the ultra-low interest rate period, this is when the zero interest rate era began. Right here, as you can see, the zero interest rate era continued for quite a while. Nevertheless, the funds in money market fund market money assets actually increased. What this suggests is that there are two different investment tendencies. Some people are only obsessed with cash-like assets, while people like us continue to invest in the United States stock market regardless of interest rate cuts or hikes. Therefore, since there are people who invest in the stock market and others who invest in cash-like assets, the logic is that even if the Fed cuts interest rates, the assets in MMFs won't necessarily move over to the stock market. Pasaku Ariel Ro makes it clear that he's not saying this is bad news for the stock market. Just because there's an abundance of cash-like assets doesn't mean it's negative for stocks. But he just thinks that this isn't all that useful for predicting anything. That's what he's saying. The Fed will lower interest rates in the future, and when the Fed lowers rates, the interest you get from cash-like assets will naturally decrease. So, when interest rates fall like this, many people claim that a lot of money will flow into the stock market, but that's not something you should claim. Because even in this kind of zero interest rate situation, the people who invest here didn't budge and kept putting their money into the money market. This historical fact is telling us something. Next, let's hear Mijun's comment. From now on, let's take another look at why we're investing in United States stocks. Now, the article above showed through a chart that even when the Fed cut interest rates in the past, there wasn't a large outflow of funds from money market funds to the stock market. What about during periods of interest rate cuts? Generally, the attractiveness of safe assets decreases because interest rates fall and the attractiveness of risky assets goes up. Nevertheless, the historical fact that money market fund or money market fund capital did not move suggests that the owners of these funds are a clearly distinct group of investors who prioritize capital preservation and stability over aggressively changing their portfolios according to market conditions. That's how I see it. Some people like us buy more stocks when interest rates fall and remain invested in United States stocks even when rates rise. On the other hand, there are also people who say, even if interest rates drop to zero, I'd rather just hold cash. The issue here is that some stock investors often consider the huge amount of money in MMFs as potential buying power that will eventually flow into the stock market. And that's how they get a sense of psychological security. But we've already confirmed that this logic doesn't hold up. However, if this money doesn't actually move, then the stock market has to continue its upward trend, relying only on the power of existing participants, without any new inflow of funds. That's how we can interpret this situation. Therefore, when it comes to the stock market, people talk about things like earnings, buying trends, themes, artificial intelligence, and momentum. Even if the market enters an overheated phase due to these factors, it's unlikely we'll get a sudden cash inflow to support liquidity. That's our conclusion. This means stock investors have already spent all their cash buying stocks. So, for stock prices to rise further, additional cash needs to come in, but you shouldn't expect that money to come from the money market. And in this case, the liquidity circulating within the market gradually decreases. If people keep buying without any new inflow of funds, eventually there won't be anyone left to buy. Then liquidity will dry up and a correction could occur. That's the logic that can be drawn here. So, if we think about it up to this point, we realize why there is no market where stock prices just keep rising endlessly. And I'd like to explain one more thing. In the end, the mechanism of the stock market, if you look at it in the short term, is close to a zero-sum game where if someone makes money, there inevitably has to be someone who loses money. So, in that case, it's not that new wealth has been created, but rather that wealth has been transferred among the participants. It's just that the money that belonged to one person has gone to someone else. If I make money, it means someone else lost money. That's how you should see it. What this means is that the chances of winning money are low. It's 50-50. If I win, someone else loses, and if someone else wins, I lose. That's just like rock, paper, scissors. The probability of success in investing is low, which is why short-term investments have even lower chances of success. That's what I want to say. But from a long-term perspective, the stock market is not a zero-sum game. It's clearly a positive-sum game. I want to explain why it's a positive-sum game by summarizing the reasons into two main points. First, stocks are not just pieces of paper that are traded. Stocks represent ownership in companies that generate real value. But what about the companies behind these stocks? They create technology, improve production efficiency, and open new markets. And through this process, they produce more goods and services and generate more profits. So, companies generate more profits this year than last year, and they aim to create even more net profit next year and the year after that. And furthermore, companies are likely to achieve even greater growth by reinvesting the profits they earn back into the business, building new factories, and conducting research and development, or R&D. As production and growth continue to increase like this, the market capitalization can also go up. What that means is, as time goes by, the overall size of the economy can continue to grow. If a company valued at 10 billion won 10 years ago grows steadily, it can reach 1 trillion won, a tenfold increase. Not only the people who invested 10 years ago, but also those who started investing along the way, can all share in the wealth. That's how we can sum it up. Now, this means it's not that we're taking someone else's money, but rather that we're sharing the newly created value together. That's how you should see it. So, just because I made more money or increased my profits, it doesn't mean that someone else lost money. That equation no longer applies. That's because the total has increased over the past 10 years. And the second reason why we need to focus on long-term investing is because there's a high possibility that more investors will enter the United States stock market. As more and more investors from around the world enter the United States stock market, the total investment capital will naturally increase. Even just 10 years ago, there were hardly any Koreans investing in the United States stock market because it was so difficult to invest back then. But as time goes by, more and more Koreans are entering the United States stock market and investing their money there. But it's not only Korea, right? A lot of people around the world are leaving their own countries, and now, with just the press of a button, they can buy and sell United States stocks. Over time, it's increasingly likely more investors will enter the United States stock market, causing investment inflows to keep rising. I mentioned before that the stock market is like an auction, and let me explain why it's considered an auction. We're basically placing bets on stocks. I might say I can pay $100, someone else might offer $101, and another person might go up to $102. In this way, the person who bids the highest price gets the stock. Therefore, the law of supply and demand applies. So if liquidity increases in the United States stock market, companies' values can be evaluated more appropriately in the market. If demand increases, more investors enter the market and investment grows. According to supply and demand, stock prices will inevitably rise. This is the second reason to consider. Let me summarize the two main reasons why we go all the way to the United States stock market to invest. First, American companies will continue to grow and generate more profits. Stock prices are earnings multiplied by multiples, right? Among these, earnings are bound to keep rising, so it's highly likely that stock prices will go up as well. The second reason is that more and more investors from around the world are flocking to the United States stock market, so the overall market liquidity and investment funds are bound to keep increasing. Structurally, the United States stock market is designed so stock demand will keep growing. That's how you should view it. If that happens, the multiples will go up. Stock prices are earnings times multiples, and if both earnings and multiples keep rising, then the overall market capitalization of the United States stock market, as well as the market cap of the United States stocks I'm investing in, will inevitably go up. This simple logic holds true. So, in my opinion, there still isn't an investment destination with a higher probability of success than United States stocks. That's the conclusion I can reach. I'll wrap up today's Mijiwon broadcast with the Mijiwon podcast as well. The topic of today's podcast is the Federal Reserve. As I mentioned in the previous article, the Fed has an important event on Friday, and this event is really important. Actually, a really terrible figure was announced last week. It's the producer price index or producer price index. Inflation was reported to be much higher than what the market had expected. So, with the producer price index being reported this high, there's a concern that the Fed might not cut interest rates, and that's causing some anxiety. So, a lot of investors are paying close attention to what the Fed chair will say this Friday and whether his stance will be hawkish or dovish. In this podcast, we'll talk about what role the Fed will play this week and how investors currently participating in the United States stock market should view the Fed's actions. August 19th, that's all for today's United States stock news. If today's broadcast was even a little helpful for your investment activities, I would really appreciate your comments and likes. Now, I've sent you the second broadcast through Kuala Lumpur. As time goes by, I'll gradually recover my condition so I can create a broadcast that you can enjoy more and watch more comfortably. Let's keep fighting together until we retire by investing in United States stocks. Have a happy day, thank you. Hello, Miju's family. Did you start your day with energy? Maybe because the kids came back from school safely yesterday, the way to school today is going smoothly too. Even though it's only the second day, I feel at ease because it seems like we've already adjusted a lot. I'm proud to see that we're adapting well to this new place, so I'm starting the day with a satisfied heart. Hello.
Did you start your day happily? Our daily life starting at KL, I feel like I'm adapting well and doing a good job too. This morning, I already feel like I've gotten used to daily life here, so let's move right on to the analysis article.
Yes, that's right. This week, I think everything really depends on the Fed. Of course, there are also talks related to Ukraine, but all eyes in the market are on the Fed. That's right.
Last week, there was a lot of data, but this week, it's more about seeing what the Fed thinks after receiving all that data. On Wednesday, Federal Open Market Committee meeting results will be released, along with Fed Chair remarks at the Jackson Hole Symposium. The market keeps expecting a rate cut in September. Will it really happen? I'm curious, yes.
That's really a key question. So today, we're going to take a close look at the current situation regarding the possibility of a rate cut in September, especially since last week there was the producer price index shock that surprised the market. We'll focus on how that's affecting things. And we'll also go over the major corporate earnings to be announced this week, as well as the short-term market outlook.
That's great. I was curious, so this is perfect. First,
market expectations for a September rate cut are clearly wavering.
I see.
Yes, even just last week, Chicago Mercantile Exchange Group data showed the probability of a rate cut in September was nearly 100%.
It was almost a sure thing.
Yes, there was even talk about whether it would be a 25 basis point cut or a surprise 50 basis point cut.
That's right. But why is the mood shifting? Did something happen?
Last Thursday, the producer price index was released and exceeded expectations. Reviewing the Chicago Mercantile Exchange data now, the probability of a September rate cut has fallen to about 85%, dropping more than expected.
85% is still high, but it's much lower than 100%. Was the producer price index that significant for this to happen? And why does that affect expectations for a rate cut?
Yes, the month-on-month increase was a whopping 0.9%. The market expected it to rise by just 0.2%, but it far exceeded that. Year on year, it rose by 3%, which is much higher than last month's 2.4%. We should view this as a clear sign that production stage price pressures are rising again.
A 0.9% increase is really unexpected, isn't it?
But what's important now is that this rise in producer prices could eventually, with a bit of a time lag, lead to higher consumer prices like the Consumer Price Index or the Personal Consumption Expenditures Index that the Fed pays close attention to. From the Fed's perspective, they might not be fully confident yet that inflation is definitely heading toward their 2% target. When data like this comes out, it becomes very difficult for them to lower interest rates too hastily. So,
if the prices of goods produced by companies go up, there's a high chance that the prices of the things we buy will eventually go up as well. When the Fed sees this, they might think, oh, inflation still isn't under control, and hesitate to lower interest rates or even delay it.
That's correct.
The Fed must be struggling to decide, yes.
So, What's in the Federal Open Market Committee minutes coming out this week, and especially the tone of the remarks by the Fed chair or members at Jackson Hole, has become even more important now. In this kind of macroeconomic environment, there are also a series of important corporate earnings announcements scheduled for this week.
Yes, which companies are they?
Palo Alto Networks operates in the security sector. For home improvement, there's Home Depot, and the discount retailer TJX will also see Walmart's earnings, viewed as a key barometer of United States consumer trends.
It sounds like there are mostly retail and distribution companies, so could these earnings give us any hints about the future direction of the market?
I believe the performance and future outlook or guidance of retail companies like Walmart are important. I think this is really important. If consumers appear to cut spending, worries about an economic slowdown may rise, highlighting the need for the Fed to lower interest rates.
Yes, that could be possible.
If earnings are much better than expected, people may think, oh, the United States economy is still doing well. In that case, it could also give the Fed a reason to delay cutting interest rates. In the end, how solid the United States consumer market is right now seems to be the key point.
I see. That will be an important clue to understanding the consumer market.
Yes, I have a similar perspective too. Let me add a bit from a technical perspective here. I remain positive about the market in the mid to long term. I'm keeping my year-end S&P 500 target at 4,700, but we should be cautious in the short term.
Why just in the short term?
Technically, the S&P 500 index is currently in a pretty overbought territory. If you check secondary indicators like relative strength index, there's a negative divergence. The index keeps rising, but there are also signs that the actual upward momentum is weakening. Since the low point in April, there was a very small correction at the end of July, but it's pretty much been going up without a break, so analysts think this might be a point where a healthy correction could come. Within the next few weeks, we should be open to the possibility of a correction of about 5% to 10%, especially centered around tech stocks. I think it would be good to respond accordingly.
I see. So you're saying that while the long-term direction is positive, in the short term, some consolidation may be necessary. That's something investors should keep in mind, right? That's right.
All right, then shall we summarize what we've discussed today? This week, the main thing is to check the Fed's stance. That sums it up. Because the producer price index was higher than expected, expectations for a rate cut in September have slightly diminished. In this situation, the key factor that will determine the market's short-term direction is what message the Fed will deliver at the Federal Open Market Committee minutes or the Jackson Hole Symposium. Also, pay attention to major retailers' earnings announcements. That sums it up.
We shouldn't miss the Fed's statements or corporate earnings. Both need close attention. Thank you so much for your analysis today. I hope that all of our Midron family members found today's discussion helpful and that it assists you in making wise investment decisions.
Yes, finally I have this question for everyone. If
the Federal Reserve continues to maintain a hawkish stance, saying that they are still concerned about inflation contrary to market expectations, is there a possibility that the short-term market correction could be deeper than the 5 to 10% range we are currently anticipating? I hope you'll take some time to reflect on this question and prepare for the upcoming market volatility. Then we'll see you next time with more useful information.
Thank you for being with us today. Have a wonderful day.
Thank you.
The beginning of a small dream is important. Shall we plant a hopeful future together? Growing little by little every day. Is there excitement in your heart? Let go of your greed. It will be the same this time. The result continues the process. Even if a dark adjustment comes, I'm not afraid. I'll hold Miju's hand and move forward, becoming the light of an unseen tomorrow. A happy investment, cheering on each other's dreams. Let's walk together down this beautiful downhill path. A happy investment together with Miju until the day we all boldly retire with Korean stocks together. Korean subtitles by Han Hyo-jong.
in the next video.